Most investors don't lose money because of bad luck, they lose it because they miss the warning signs. And once you learn to spot them, you'll never look at a stock the same way again. Because the truth is, failing companies don't collapse overnight, they leave clues.
All right, welcome to The Explainer. Today, we're diving into something super important: how to spot the red flags of a failing stock before it's too late. The goal here? To help you protect your hard-earned money. So here's a big question. How can a company's stock just sink while the founders seem to be doing great? Well, it often starts right at the top with the leadership. The story they spin? That can be your very first clue that something's not right. Let's call this first red flag the founder's God complex. You've probably seen it. It's when a founder's story becomes bigger than the business itself, when their grand vision and polished image are actually hiding some pretty serious problems under the hood. You know, when you hear a founder say something like this, that's when you need to be extra careful. This idea that they have zero interest in money and are just on some noble quest, it's often just a way to distract you from what the numbers are actually saying. And this is really the key, isn't it? You've got to figure out if you're looking at a messiah or a builder. One sells you this grand epic story. The other one, they're focused on building a real, profitable, and ethical business. And hey, there's nothing wrong with a founder who's honest about wanting to make a profit. In fact, that's exactly what you want to see. It's the bedrock of a solid company. This whole God complex thing often spirals into this promise of being number one in everything. Seriously, one day they're revolutionizing AI, the next it's e-scooters, and then it's maps. But when you look for solid execution or, actual profits, crickets. It's all promises about the future with nothing to show for it today. Okay, so that brings us to the actual business strategy. Because that belief that they can do anything and conquer any industry, it often leads right into our next big warning sign: diversification's dangerous downfall. This is when a company loses its focus and in the process destroys value. I mean, history is just full of these cautionary tales, right? Companies like these tried to be everything to everyone. One minute they're a great steel company, the next they're jumping into telecom or real estate or media. This rapid-fire expansion into totally unrelated fields, well, it's usually a one-way ticket to failure. And the stats on this are just brutal. Think about it. For every 10 companies that try this crazy rapid diversification, a whopping 8 of them end up failing. 8 out of 10. Yeah, a couple might make it big, but the odds are just massively stacked against you as an investor. You really have to ask yourself if you're willing to make that kind of bet. All right, let's talk about a financial trap that's a bit more subtle, but can absolutely demolish your returns, even if the company looks like it's growing. I'm talking about the constantly shrinking pie, or in finance terms, share dilution. And to understand this, we need to look at one simple but super powerful metric: earnings per share, or EPS. Basically, this number tells you how much of the company's total profit belongs to each and every share you own. It's your piece of the pie. So, let's break down the math here, because this is where your investment can get hammered. Imagine a company makes 100 rupees in profit, and there are 20 shares. Your EPS is 5. Simple. But then, they need cash, so they issue 20 new shares. Now there are 40 shares, but the profit is still just 100. Suddenly, your EPS is cut in half to 2.5. Just like that, your slice of the pie got a whole lot smaller. And believe me, this isn't just some textbook theory. Take a look at Vodafone Idea. Their share capital just exploded from around 8,000 crore to over 70,000 crore. Why? Because they kept issuing new shares. And for investors who held on, the stock price was basically flat for 5 years. That right there is the destructive power of dilution. All of this really boils down to the most fundamental question you can ask as an investor. Are you putting your money into an actual functioning business, or are you just buying a bunch of promises? And here's a huge red flag to look out for: what I call convenient profits. This is when a company has been losing money for ages, and then magically, right before an IPO or some other fundraising event, they suddenly turn a profit for a quarter or two. But once they've got your money in the bank, poof, those profits disappear just as fast as they showed up. Honestly, this is such a powerful gut check. If a company isn't making a profit yet, it's not really a business, right? It's a project. And if the insiders, the founders, their family, aren't willing to put their own money in to keep it afloat, why on earth should you? It's a pretty clear sign they're asking you to take a risk they're not willing to take themselves. Okay, so let's pull all this together. To make this super practical, here's a quick investor checklist you can use. Think of it as your guide to asking the right questions before you invest. Next time you're looking at a stock, just run down this list. Seriously, ask yourself, is this founder a storyteller or a business builder? Is the company laser-focused or are they all over the place? Is their growth coming from actual profits or are they just printing more shares and shrinking my stake? Is there a real, consistent history of making money? And the big one, am I buying a business or am I just buying hype and hope? And in the end, it all comes down to this. The next time you're about to invest, just stop and ask, am I buying the business or am I just buying the hype? Being honest with yourself on that one question could be the single most important thing you do to protect your money.
If you want to invest smarter and avoid costly mistakes like this, hit subscribe, because this is just the beginning.